Welcome to The Explainer. Today, we're diving straight into Royal Bank of Canada's massive Q2 2026 financial results. We're going to find out exactly how they are navigating this incredibly complex, ever-shifting global economy. So if you want to know how a top-tier financial institution turns economic crosswinds into record profits, well, you are definitely in the right place.
To make sense of all this data, we've got a clear roadmap today. We'll start with the headline financial results, do a business segment breakdown, check out their capital stability and risk, look at strategic growth and innovation, and finally, wrap up with shareholder returns and outlook. Let's get into it.
Section 1. Headline Financial Results. Exceptional Outcomes.
You know, this quote from the CEO really perfectly sets the stage for us. He highlights how complex the world is becoming right now, but honestly, as you're about to see, the bank isn't just surviving this environment, they are absolutely crushing it. Let's look at the hard numbers. $5.5 billion. That right there is RBC's Q2 net income. Just a massive number for a single quarter. But the real kicker? That represents a 25% year-over-year growth. Think about that for a second. In a mature, heavily regulated industry like banking, bumping your net income by a quarter in just 12 months is literally a staggering achievement. So what does that actually mean for the individual investor? When you break that $5.5 billion down to diluted earnings per share, we are looking at $3.85. That's up 27% from the prior year. It just goes to show that this bottom-line profitability is highly accretive on a per-share basis. And perhaps most impressively, they generated a 17.2% return on equity this quarter. As you likely know, ROE is kind of the golden metric for bank efficiency, right? Pulling a 17.2% return proves management is highly effective at taking your shareholder capital and actually turning it into profit rather than just letting it sit there. Moving right along to Section 2, the Engine Room Business Segment Breakdown. As this breakdown perfectly illustrates, RBC isn't just one giant monolithic entity, it's a diversified powerhouse. Looking at the revenue pie, it's led by personal banking at 34% and capital markets at 26%, with wealth management sitting right behind them. This kind of diversification is absolutely crucial because, if one sector of the economy hits a speed bump, RBC's got other engines to keep the whole plane flying smoothly. And when we look at the pure net income generated this quarter, those twin engines of personal banking and capital markets, they're doing the heavy lifting. Personal banking brought in roughly $1.8 billion. While capital markets pulled down $1.4 billion. Oh, and wealth management easily crossed the billion-dollar mark too, adding $1.1 billion to the bottom line. It's just a broad-based win across the board. So what's actually driving all this? Well, that 17% net income bump in segments like Canadian banking came down to a really fascinating dynamic. Higher net interest income paired with lower provisions for credit losses, or PCL. Essentially, the bank is making wider margins on the interested charges, while at the exact same time needing to set aside way less emergency cash for bad loans. Revenue up, expected loan losses down, it's the perfect recipe for the kind of profit explosion we're seeing here. All right, Section 3, the Fortress, Capital Stability and Risk. Before we throw too many numbers at you, let's just quickly decode CET1. Think of the Common Equity Tier 1 ratio as basically the ultimate measure of a bank's financial fortress. It compares their core equity capital against total risk-weighted assets. In plain English, if the market crashes tomorrow, exactly how thick are the castle walls? Well, RBC proudly reported a highly robust 13.5% CET1 ratio this quarter. This is huge because it remains well above strict regulatory minimums. Sitting at 13.5% means the bank isn't just safe, it's got the excess capital required to support real volume growth. Their foundation is so secure, they can comfortably afford to lend more and expand. Next up is LCR, the Liquidity Coverage Ratio. If CET1 is your structural strength, LCR is your immediate cash reflex. It simply tells us if the bank holds enough highly liquid assets on hand to survive a sudden, short-term crisis. Sitting super comfortably at 126%, which is actually up from 124% last quarter, by the way, RBC is proving their balance sheet is incredibly resilient. Anything over 100% means you've got more liquid cash on hand than your expected outflows in a 30-day stress test. So at 126%, they are holding a massive buffer. They are playing a very safe, very strategic game here. Let's move on to Section 4, the Horizon, Strategic Growth and Innovation. Looking at their strategic timeline, they've got a very clear, phased focus right now.
Currently, in Q2 2026, they're busy digesting the massive HSBC Canada acquisition and working through those fair value impacts. Looking out to 2027, the focus shifts to integrating global growth through digital innovation. But wow, the most staggering takeaway here? They are actively targeting $1 billion in enterprise value specifically from artificial intelligence by 2027. They aren't just throwing AI around as a tech buzzword, they've tied a literal billion-dollar target to actually implementing it across the entire organization.
Which brings us to our final section, shareholder returns and outlook.
RBC directly rewarded investors this quarter by hiking their quarterly dividend by 12 cents. That brings it up 7% to $1.76 per share. And because their earnings grew so aggressively, they're managing to do this while keeping a very healthy, highly sustainable payout ratio of 42%. So they're distributing wealth to you without starving the business of the capital it needs to keep growing.
But wait, they didn't stop at dividends. RBC also announced a massive share buyback program, intending to repurchase and cancel up to 45 million common shares. That's about 3% of the entire bank's outstanding stock. By shrinking the supply of shares on the open market, they're fundamentally driving up the intrinsic value and ownership stake of every single share you currently hold in your portfolio.
So when you step back and look at this whole picture, combining premium 25% profit growth, an unshakable 13.5% CET1 balance sheet, and massive targeted investments into AI, it leaves us with one incredibly compelling question. With a 7% dividend increase and a 45 million share buyback fueled by $5.5 billion in quarterly net income, is RBC writing the ultimate blueprint for the modern bank? Balancing aggressive growth with conservative risk management like this is incredibly rare. Thanks for tuning into The Explainer today, and I highly encourage you to keep exploring the numbers behind these headlines.